Welcome back, everybody, to the Informed Home Buyer Podcast. I'm your host, as always, Rich Curtis, and I have with me my co-host this morning. Hey, Dave, how you doing?
I'm good, Rich. Thanks for having me. By the way, it's this afternoon, but we run into that all the time. We lose track of time here and get behind.
Yeah, that's right. Well, we were too busy this morning trying to catch up on all the news that changed what we were going to talk about. But
I
it's
know,
afternoon by the time we can talk.
right? And don't look at any news updates because we might push to the evening. So
That's right. So today what we're talking about for you guys is that we are seeing prices already starting to decline as predicted. In an episode about 2 weeks ago, we talked about a July perfect storm brewing of some numbers and some uncertainty factors that we think are going to continue to potentially push real estate prices down. So in this episode, we're going to refresh your memory on what those factors were really quick. We're going to go over the numbers as we have them for the April numbers. They're all out, and show you where we're already seeing those declines and where the numbers are starting to stack up as evidence for that potential perfect storm, and some places where it's not. We're going to show you where some of the numbers are a little bit weird and how you can interpret and pick which numbers to look at and which ones not. We're going to talk about Jerome Powell, the head of the Fed, meeting with Donald Trump just today, reiterating the Fed's policy and that they're not going to back down and change that policy. And we're going to talk about some bombshell court cases that could provide some injunctive and perhaps permanent relief to all this tariff uncertainty, which could actually be the one thing that could maybe not change the July perfect storm, because we're not going to see these cases wash out by then, but could towards the end of the year take some of the uncertainty off the table and restore some sanity and stability to the real estate market. So you're going to want to stick around to the end for that. We've got a lot to go over, so we're going to jump right into the numbers. I'm not going to linger on any of the numbers too long for you. I just want to set the stage. Before we do that, just a quick reminder, the July perfect storm that we referenced, and if you haven't watched that episode, I encourage you to do so. I'll put it in the show notes down below and a link at the end. The July perfect storm we're referring to is that the Liberation Day tariffs come unpaused on July 9th if the president doesn't get the trade deals that he wants. That we are likely to see some short-term empty shelf shortages because of the pause in goods coming from China while the China tariffs were really high. The goods are already on their way. There will be relief for that, but we will see some June empty shelves that are going to potentially freak some people out. Towards the end of July, around July 30th, we will see the preliminary round one estimates for the Q2 GDP. I know that's a bunch of gobbledygook, but what that means to you is if those numbers show a contraction in the economy, that is the signal that we are officially in recession. So we could see it called for recession by the end of July. And then just over the line in August, on August 12th, the relief we got on the China tariffs, where they went from 145 down to 30%, is due to expire as well if the president doesn't get the trade deal he wants with China by then. All of that stacking up on top of the fear, uncertainty, and doubt we've already had, and the numbers I'm going to show you here is kind of working towards a July perfect storm of seeing some actual price decline, some actual real estate losses for us in the marketplace in July. So there's your update, and we go much deeper into that other episode. We're going to jump into the numbers here, and we're going to start at the state level, and we're just going to move quickly through this. State level numbers are not really your friend. Real estate is hyper local, but what these do is give a little credence to and point you in the direction of these macroeconomic trends. Are things trending up? Are they trending down? That isn't indicative necessarily of exactly what's happening where you are, and that's why we're going to get to the county by county data in a minute. But from the state level here, you can see the total active listings in the state of California reached the highest level in April since 2019. That's a big deal. We've had very low inventory all the way since COVID. Inventory was what was driving the market prior to the interest rates going up. And now we're seeing a lot of relief here in the inventory, meaning that lock-in effect. And Dave, can you kind of remind people from a lender perspective what this lock-in effect has been over the last few years since COVID?
yeah, and what that lock-in effect really is, Rich, and is folks that are fortunate on this call that were in a situation where they owned a home and they were able to either refinance or purchase with, somewhere around 3%, some sub 3 interest rates, anywhere really below 4. You had that rate locked in, and so you were hesitant to sell or move and sell your house, become perhaps an unintended landlord. You kept your house because the interest rate was so low, but really put your life kind of on hold for a bit in terms of I sell today, I can go get the house that I really want or the location I want, but I might double my interest rate. So folks just really held tight. We're starting to see some of that kind of, you know, break away. And as listings, as rich as you see those come on the market, I'm pretty confident that a good portion of those listings come on the market are folks that had secured a lower interest rate.
Yeah, and that's what this chart is showing here is that previously we have had really low inventory right up until the last few months, in large part due to that lock-in effect. And what this is showing us is that lock-in effect is actually easing. People are saying, hey, I'm either at the maximum real estate value. They think what we think, which is prices are going to decline. So I'm going to take profits and move on now, or they are seeing all the uncertainty in the marketplace and they want to move on to that next step before, because they just don't know what's going to happen next, and they feel good enough where they're at profit wise on the home that they're willing to take the risk on the interest rates, and that they're seeing that the interest rates likely aren't coming down, and certainly not to the levels they had them at. So if they want to move on with their life, they have to accept the new interest rate reality. Now, as you're looking at this graph, it might be a little hard to see on your screen, but it's the very light blue that is the 2025 numbers, which of course we only have through till April, but you can see that light blue line being exceptionally high in April, showing that we have just a massive amount of listings compared to where we were before. And, compared to the 2019 numbers, which are the darker blue numbers, you can see we're right up close to there in April of 2025 here. So we are just seeing a lot more inventory come to the market, which means the lock-in effect is easing. But spoiler alert, we're going to see the buyers are not coming to match that. The buyers that have been waiting for this to happen, they've been waiting for more inventory, now are not coming back to the table because of all the fear and uncertainty. So this one here, you can just see pending sales have declined for the 5th straight month. Now, of course, pending sales turned into closed sales, and we're going to go over new listings versus closed sales in a moment. But what this is showing is that even though we have a lot more listings coming to market, we're having less and less of them month over month over month for 5 straight months going pending. So less buyers are coming to the table while more sellers are coming to market. And that is always a recipe, regardless of what's going on in the rest of the market. That is always a recipe for price declines. In this case, Dave and I were talking offline, this inventory going up, is that what's causing price decline? And that's sort of like the distracting injury, if you will. If you crash on your skis and you break your leg and you hit your head really hard, when the ski patrol comes up, you're wailing about your broken leg, even though your concussion might be worse or a more dangerous thing for your body. And so it's really the concussion that's causing your problems, not the broken leg. This is kind of similar. The inventory here is what we see that is causing the price declines, but what's causing the inventory to rise is the fear, uncertainty, and doubt due to the macroeconomic forces and the tariffs and the trade policy kind of insanity that we're seeing going on. So while we're focusing on inventory, know that the inventory rising and people cracking loose from that lock-in effect is mostly due to the fear, uncertainty, and doubt. Now this one here, California median home price reached a new all-time high. So wait a second, Rich and Dave, you're giving us all this doom and gloom. Prices are coming down. Why is the median home price reaching an all-time high while you're showing all this other downward trending data? And like I said, we're going to show you where the numbers get weird. The thing about California is we have markets ranging from, Pollock Pines to Santa Barbara, right? So you might, and to Bakersfield, right? So you might have places with these tremendously low for the state median home prices that get hit pretty hard. And then you might have some of these places that have really high median home prices that are a little more resilient. And then you have weird places like we'll show you Elorado County starting to show declines. Sacramento is showing a little more resiliency at the moment. So when you put all of that in the gumbo, what shakes out is statewide. Yeah, year to year, we are at 0.7% up. So we were already at an all-time high because of all of the, pandemic forces and low inventory. And now we've gone 0.7% up. To me, I would read that 0.7% really as almost a flat market. And as you'll see, 47 out of our 58 counties are showing a year-to-year decline in their median home price. There's just a couple of whoppers in terms of home value that are carrying this. So that's why it's always important to drill deeper into the data and not get kind of skewed by this. I saw one, Dave, the other day that was saying Oh, mortgage defaults are off the charts, someone on Instagram. And I thought,
Yeah.
that's not what I'm seeing in the data. What are they talking about? When you zoomed in on the little fine print down in the lower right corner of the graph, it was multifamily. So this person was presenting this as doom and gloom for the single family home market, but this was like apartment building defaults, So
Right.
always good to drill down. Sales have dropped to a 3-month low. So this is showing, month to month, we're down 3.4% in terms of sales volume. We're down 0.2% year to year in terms of sale volume. Again, that 0.2, let's call that flat. I'm not gonna put a lot of energy into a sub 1% number, but 3 months in a row, sales volume is dropping. That is going the wrong direction.
And I think, Rich, simultaneously that, and I don't know if now's the appropriate time, but mortgage applications are down 6% year over year. Um, and so, now you have a combination of inventory levels increasing, starting to see price easing, and like you mentioned, fewer buyers or fewer mortgage applications. So down 6% year over year is pretty significant, and we'll see little short-term bumps up and down based on how the interest rates move. But that's and I think also the psychological effect. Not only is it the FUD, the fear, uncertainty, and doubt for buyers, but if we go back for the last 3 or 4 years, if you were considering buying a home, there was a sense of urgency, right?
Yeah.
Like there's going to be multiple buyers. If I don't not first one out there, write my offer, write it strong. Well, buyers are seeing houses pop up too. They see those for sale signs all over the place, and
And the
uh,
on market time's getting longer, so they don't have to
yeah,
jump as quick.
right. And with not seeing prices, and seeing some price reductions, it's like as a buyer, that sense of urgency just kind of goes away. Now the question is, do you wait a month? Do you wait a year, 2 months? And obviously everybody's different. Their situation's different. We could talk through that and the 5 fundamentals of what makes a qualified buyer. But all this is, part of that kind of, I would say, perfect storm combination to see a change in this market.
Yeah, I think that's a really good point because when we look at the closed sales data and we say closed sales are going down, that's an indication of how many buyers in the last month did or did not buy a home. And so that gives us a 1 month picture of the buyer pool. But to your point, having new mortgage origination applications down 6% year over year, that's an indication of the future buyer pool. So that's saying over the next several months, there's 6% less people coming to market interested in buying a home than before. Now, not every person who comes to you for a mortgage, I assume, gets one or ends up buying a house. So it won't be a 1-to-1 6% reduction in the buyer pool necessarily. But in your experience, Dave, you've been doing this 25 years. From the time someone calls you and fills out, a new application, an origination application, on average, if they are going to be a successful buyer, how many months from that date until they are out shopping?
I would say usually they've within 3 months, unless there's some underlying criteria, some credit cleanup, some other things, and we've had mutual clients that maybe they relocated and, one spouse is working, the other spouse might get a job or other situations where they may want to put that on hold. And then it comes into what's your current living situation? Are you in a long-term lease or short-term lease? So all a little bit different, but I would say for the most part, it's less, for the last several years, it's been less than 90 days. We start talking to someone and most people just don't want to put through the effort until they've mentally made the decision that they're, kind of ready now. As much as you and I encourage people, hey, you might be 6 months or a year out. Now's the time, or even a year longer. Let's start having a conversation, put your ducks in a row, so that when you are ready, you're prepared, and we can only, help guide you some things that you can do ahead of time. So
Yeah, and so a certain percentage of these people, we're never going to make it to market anyway. Some of them won't qualify. Some of them will have a life-changing event and they'll wash out, So, but even if you cut that in half, which it's going to be better than half of those people would have made it to market, but even if you cut that to a 3% reduction in a new buyer pool over the next 90 that washed out over the next 90 days, well, the next 90 days is the prime summer buying season. So we're going to feel that somewhere between a 3%, 3 and 6% reduction in the buyer pool, and that's going to exacerbate the discrepancy or the difference between new listings coming to market and closed sales, which is also going to exacerbate the downward pressure on prices. So I think that's a key metric to bring to the table. Thanks for bringing that up.
Yeah, for sure. And also obviously the high interest rate environment that folks are just kind of waiting to see. And, according to Mortgage Bankers Association, the reason for this drop is still uncertainty into the economy and elevated interest rates. So the point to those two things right now are the main factors.
Yeah, and a little bit later in the show, we're going to give you an update on where we see interest rates going. But let's just say you shouldn't be hoping for a 3 or 4% anytime soon. um,
Yeah.
so this slide is just talking about inventory levels. Now this is statewide. So statewide, we're up almost a full month of inventory. And that is statistically a relevant shift because it's a shift from a strong seller's market to a neutral market. So when you hit 3 to 4 months of inventory, you're getting into neutral market mechanics. And we've been in strong seller's market mechanics, 2 months or less of inventory for a good chunk of the pandemic, less than 1 month of inventory since, April, May of 2020. So this is, you say, oh, 1 month of inventory doesn't look like much, but that's actually a dramatic market shift because we've had 5 years essentially of 2 months or less. So the market has now done its first step of shifting out of a strong seller's market and into a neutral market, which is what this one is showing. Now, this is just a April overall market snapshot for Sacramento County. So we just finished the state numbers. Let's drill in a little bit. What does this mean, locally? So Sacramento has got a median home price of $550,000 here, and I'll highlight a little of the data for you real quick. It's hard to see on your screen, but these numbers here, you're seeing we've got a negative 1.8 month to month and a 0.3 year to year positive. So Sacramento is not actually seeing year to year declines. That 0.3%, again, when it's less than 1%, I don't put a lot of stock in it. I'm going to call that essentially a flat market, but we're showing monthly there a downtrend month to month. So, if we see a couple more months of that, we're going to see that year to year number continue to shift to the negative, which is what I expect to see. Home sales numbers, again, Sacramento here showing some resilience. It's holding itself strong here a little bit with home sales up 6.2 year to year and up 19.7 month to month. Now, the month to month number right there, you got to take that one with a little bit of a grain of salt because it, we're seeing some seasonal stuff in there. So when it comes to month over month numbers, we're going to have a seasonal component that is going to say, as we march towards summer, we always see more listings come to market. So that number looks a little larger than this one here than in reality it actually is. So don't sweat that as much, but we are still seeing an increase in sales there for Sacramento. So again, when it comes to locally, some places do a little bit better than others. When it comes to the inventory, you can see here, we're going about 2.8 months of inventory for Sacramento. That's a flat month to month, but year to year, that's a 33% increase in inventory right there, 33% up from the year before. So 1/3 more inventory. That is another data point that says it's unlikely that year to year price strength is going to hold. Let's pop into, there we go, Elorado County. These are the only two counties we'll do a deep dive into. We got 675,000 median home price. But here now we are looking at year over year. Got that dot is too big, folks, isn't it? I'm blocking out your information. Let me get that down for you. There we go. All right. So we've got the 6.6 here, negative month to month, but we've got a negative 10.8 year to year. So we're seeing a little over a 10% decrease in median home price year over year in Elorado County. That is significant. That is showing a strong downtrend in terms of prices. And this is one of those data points that says to me that if even a couple of those other shoes drop in that July perfect storm, where some of the tariffs come on pause and we don't have trade deals in place, and it increases that uncertainty, we're likely to see these numbers here get worse in the summer buying season. Now, we're also looking at home sales. And in this case, this is the trend we've been seeing most often. Home sales are down. So we've got inventory up, number of new listings up, but home sales down 3.2% county-wide. So that again is a downturn signal where we have number of listings coming up. That lock-in effect is easing, but not as many people buying, and that's going to keep that downward price pressure going. When we scroll down to inventory too, this is really significant, showing for Elorado County 4.8 months of inventory. We'll give that the big underline there. 4.8 months of inventory. That is getting to the edge of a neutral market and trending towards a buyer's market. 6 months, 4 to 6 months is neutral. 7 months and up is a buyer's market. So that right there is showing a strong neutral market trend for Elorado County. Now, again, where I said numbers get weird sometimes. So when you look at the month to month, we are up only 9.1% month to month. But year to year, we're up 41%. I actually would say a big chunk of that 9.1% is our seasonal effect. So I wouldn't, I want to be real with you guys. I wouldn't freak out about that being like, wow, we're getting 10% a month. That is showing a burst of summer listings coming to market, not necessarily a really rapid speed up of this effect. So at 41% year over year, you can obviously see that would average out to a lot less than 10% a month. So don't freak out about the 10% a month, but no matter how you slice it, a 41% increase in inventory county-wide year over year, that is significant and something worth paying attention to. Now we'll go to just couple more slides for you on the numbers. This is and it's going to be a little small, hard to see, but this is California Association of Realtors reports on 53 of the 58 counties in the state of California. In an earlier slide, we showed you median home prices actually up a tick, like 0.7% statewide. But here you'll see 25 of the 53 counties reporting here are showing a year-to-year decrease in median home price. That's 47% of all California counties are now negative on price year to year. So we can just highlight a few of them. Alameda down 3.6%. A lot of our reload folks here to Elorado County are from the Bay Area. Contra Costa down 4.3%. Marin holding out okay at 1.2 up. Napa down 1.1. San Francisco down 1.1. Now that one is, and if that number worsens, that is sort of a canary in the coal mine to me. If you're got enough gray in your beard like Dave and I do, and you lived through the Great Recession, you know that even in the Great Recession, San Francisco it saw price declines, but it never got classified nationally as a declining market. It is that resilient of a market. And we're already seeing early signs of price decline in San Francisco. And that's one of our most resilient markets in the state. There has been a lot of relocation out of there. I think especially to the Central Valley, because we're such a great value proposition, talking about median home prices, 1.4 to 1.7 million around San Francisco, and median home prices in the Sacramento Valley where we work 516,000. So, when you're coming in at houses a third of the cost, you see a lot of flight out of there. So those numbers could be exacerbated just by how pinched the buyers have gotten in that market. We'll scroll down to a couple. Southern California is about 50-50 on the price reductions, but San Diego took a good hit at 3.1% down. Santa Cruz, this one shocked me. I lived in Santa Cruz for 7 years. It is also a very resilient market because it's a very popular place to live. It's geographically pinched. You're not building any new houses in Santa Cruz. So it's very, usually a lot of price pressure there, down 10% year over year. And then we'll scroll down to some of our local counties. Here, we've got Placer County coming in at -1. Sacramento, like I said, being a little extra resilient, even countywide, we're at 0.3% up. I would call that essentially flat, but hey, it's more resilient than we saw for Elorado County. Scrolling down, and we've got our Elorado County numbers again at the -10.8 that we showed you on the last slide. So overall, we're seeing a downturn in about 47% of the counties. The final point I'll make here is sold versus new listing, number of sold versus new listings. So we have had, since the beginning of the pandemic, very low inventory and a very aggressive static buyer pool, which means every time we got listings that came to the market, the buyers jumped off the fence, gobbled them all up, and we essentially stayed at that 2 months of inventory mark. And that has persisted for quite some time. So the green bars are the number of solds, and the blue is the number of new listings. And you can see, we'll grab my color here. You can see, we're staying in the same zone here where, yeah, we got a bunch of new listings, but the green bar came right up and gobbled them up, right? All the way through here, we're staying pretty strong, if not outpacing, right? Here we're outpacing by the end of 2020. That was the insane COVID market, right? So this is from April 2020 to April 2021. And you can see anytime we had listings, they got gobbled up. And as you'll see, that trend is reversing. Now, by the numbers, if you're a numbers learner, not a visual learner, then by the numbers down here, you can see right here, we were up 70% in listings and up 62.6% in sold. So darn near up as much in sold as we were in new listings. So the market is essentially keeping pace there. Now we'll look at 2 more time spans here. This one is from April of 23 to April of 24. And again, if we scroll down, we'll show you the percentage change numbers. We're at 21.6% up on new listings and up 17.4% on total sold. So again, just barely lagging behind, delta of 4 and some change percentage points there, but we're keeping up. So all the way through April of 24, we were keeping up. Now let's see what's going on now as we hit April of 25. So this is April 2024 to April 2025. And we'll go ahead and highlight what's going on over here on the right side of the graph. We got the new listings going up and the solds not keeping pace. We have this big delta in here. And if we scroll down to look at the actual percentages for you numbers folks in the crowd, we are up 32% on new listings and down 5% on solds, making a delta of 37.6% right there. So we've gone from deltas in the, using jargon, differences in the numbers from around 4 to 5% with solds keeping pace with new listings to solds going up, new listings going down, and having a difference of 37%. And that right there, this is the thing that's telling me, regardless of what happens, regardless of the next announcement from the president, this is going to worsen through the summer buying season, not get better. There is some potential relief coming, and we'll talk about that. But those are the numbers. I hope that helped. For those of you who aren't numbers people, I hope you're still awake and still with us here. Dave, do you want to jump into the meeting that Powell just had with Trump, what his stance was, and your read on what that means for the next Fed announcement, what the federal funds rate will do, and how that translates into mortgage interest rates, so we can give people an indication, regardless of the downward price pressure, what are our interest rates going to look like through the end of the year?
Yeah, and so good point, Rich. So interest rates are still hovering high 6, low 7s. We haven't seen any change since, the last probably month or two of our informed home buyer pods that we've been doing here. So as you mentioned, so Powell was requested to meet with the president in the Oval Office today, and that news just came out. And without directly saying it, I'm sure there was direct pressure and a request to lower the federal funds rate, pressure on the Federal Reserve. And Chairman Powell again reiterated that he and all FOMC, Federal Open Market Committee members, their number one charter is to support maximum employment and stable prices and manage inflation. They will not deviate. This will not be political. That is their charter. And they will work off the data, as we've said in all of these pods here, is that they will look backwards at the data. And when they feel like the data is stable enough and it's not a blip, then they will be in more of a position to act, and really act quickly. So, one other interesting note that came out today was jobless claims. So, claims were expected. So, the last report, the prior report was, let's see here, we got, let me get to that, was 2.9. My other computer's hanging up on me here. So, we got on those jobless claims. So, we were at 226,000 previous. The estimate was that we were going to be at 229,000 new jobless claims. We ended up at 240. So that's a fair amount higher today than what was anticipated. So, but does that mean that when the Fed meets in June, I think it's June 17th, they're not going to use that number? Okay, that's a trend, right? That's a trailing report. They're going to want more data on that. So my inclination is that they are going to need another month or two of this data before they make any decisions. So, and the same reiterated policy around tariffs is until tariffs are kind of stable and we know what's going to shake out, we're getting numbers that are all over the place on inflation and what to expect that's coming down the road. So I wouldn't expect any change in June for sure.
So we're expecting the Fed announcement in June to be leaving the federal funds rate the same.
That is correct. And there's been some chatter that, hey, you know what? And I don't anticipate it to happen, but if things go the other way, they could potentially raise or discuss that. Everything's on the table. But if inflation, starts trending out of control, then they got to use the tool and pull the lever and raise rates. I don't think that's going to happen, but anything's possible. But I would say it's more likely than not that we stay pat on current rates.
Yeah. And then just in case people don't watch all of our podcasts, which I don't think there's anybody that doesn't watch every single one out there, Dave, but reiterate for people the difference between the federal funds short-term rate and the long-term mortgage interest rates, and why, even if the Fed did lower in June, my expectation, you can disagree with me, even if they lowered, I wouldn't expect to see the mortgage interest rates move hardly at all. So can you kind of walk people, give them a quick primer on that in case they haven't been following along?
Yeah, so the Fed fund rate is really it's the rate that overnight rate that banks borrow money from the Federal Reserve. And so banks are borrowing and lending money constantly. And so that's that baseline federal fund rate. So from a mortgage rate perspective, we're looking at the 30-year mortgage-backed security, which is, we're paying attention to the bond market. And so and we've seen shown on previous pods here what the 30-year mortgage-backed securities doing, and it's hovering at 100.5 to 101. We're right in that range. I want to say we were 100.88 today, which is about the highest we've been in a week. So higher is better. We might see just some incremental improvement, but we're really hovering in that same price range. In fact, I was watching a segment where the FHA director was on and was really saying that, the Fed really needs to act now and lower interest rates to give relief to home buyers and lower mortgage rates, where, the question back was, well, last time the Fed's lowered rate, we didn't see a significant increase in mortgage rates. And that question wasn't really answered the way I was hoping, or that the consumer would want to know. So we'll just have to wait and see. And I think it's just going to take time. So if you're someone that is looking to buy a home, I would say you're more likely to see an improved purchase price point than you are to see getting relief from lower mortgage rates.
And by the way, that is almost always of more benefit for multiple reasons, right? So you gain more by purchase price coming down than you lose by interest rates going up, by the numbers most of the time, especially if it's a significant move in purchase price.
Sure.
You also that lowers your tax basis sort of permanently moving forward. Now depending on where you are, because in California we have Prop 13, so they can only go a certain amount a year. Every year after that, if you don't make major improvements. So having a lower tax basis helps. So prices coming down, in my opinion, is always better than interest rates coming down. Of course, both coming down at the same time is the silver bullet, because there's so many of our young people just haven't been able to afford houses. And so many of our elderly, and people don't talk about this very much, are trapped in houses that are inappropriate for them because the smaller house would cost them more. So you might have, elderly people in it. Like my father, actually, up until he died, was in 2,500 square foot, 2-story home that was costing him less than if he'd gone out and bought a 1,200 square foot, 1-story home that would have been much better for that season of his life, but it would have cost him double. So you get people sort of trapped in that sense as well. So prices coming down will hopefully ease that a little bit for people. But the upshot is, even if the Fed fund rate comes down, we likely aren't going to see mortgage interest rates come down. Sorry, Dave, you're going to say something?
Yeah, no, I just think, like, as you're showing all those numbers, and I'm thinking, for folks and we have every different type of folk, hopefully, that's watching this in terms of where you are in your buying or selling journey. If you have a home to sell and you're like, oh my gosh, values are coming down, I got to get that on the market. And I've always been a big fan. Like, if you sell and buy in the same market, your exposure is really low, right?
Yeah.
Meaning, if you were to sell an $800,000 house today and then go buy another $800,000 house, maybe you get it. If each one came down 10%, well, you lost 80,000, but you also got a deal of 80,000 on the home you're buying. So if you're buying in the same market now, if you're buying in another market and maybe you're selling an $800,000 house, and if it drops 10%, you're down 80,000, but then you're going to go buy in a $500,000 market. Hopefully you have some equity there, but you're only going to get a $50,000 discount on that home that you're buying. So there's a bunch of different ways to look at this. And you brought up a good point, Rich, where home values coming down is better than sometimes interest rates going up. The beautiful thing is, once you buy a home and you locked in, we don't know when that's going to be that you could refinance, but it could be a year, it could be 6 months, it could be 5 years down the road. But at some point, ideally, you will be in a position to lower your mortgage interest rate. So if you find a home you love, and you meet the criteria as a home buyer, it's all different for everyone. That's why we need to have a conversation, see if the time's right for you or not.
Yeah, I've been telling people for 20 years, and I don't think profit should be the primary metric in a house, in a primary residence housing. I think that's a disservice we as a community have done. And I think our industry too. Your house is your biggest investment. It's, and it's built the middle class. It's built more wealth for everyday working people than any other single asset class. However, you don't get the right house if you're looking at it from a profit perspective. You don't get the right hub of your life or the right community for yourself if you're looking at it purely from an investment perspective. So I don't think that's the best way to look at it. But when you do look at it from through an investment lens, all the money you make or lose on real estate, you make or lose the day you bought it, because we can never change that acquisition price. Mm-hmm. Whereas, to your point, you can change the interest rate. You have a chance, if things get better in the future and you're still a credit-worthy individual, you can lower that rate. And so that purchase, that's one of the other reasons I think purchase price coming down is always more beneficial than rates coming down, because we can never alter that cost basis in the house, that initial purchase price, but we can change the interest rate potentially.
Yeah, and ideally for those that don't have a home to sell, but you're renting, and we see values of homes come down enough to where, hey, I'm renting this, whatever, I'm renting a home, an apartment, and my rent's, $3,500 a month, but I could buy now my dream home, and I'm only paying $4,500 a month to buy this home, whatever that might be. I think where, we run into some challenges is if rents were to really fall through the floor and come way down simultaneously, then there's going to be less motivation for, renters to buy right away as well.
Yeah. And that, things kind of feed off each other at that point, right, going down. But so from the perspective of what's coming in the market, Dave and I both don't see interest rates essentially coming down. The only thing that would do that would be if people flew to the bond market for some reason. And there's been so much meaning go and purchase bonds for a safe haven for their money. And as we've talked about on other episodes, your high yield savings accounts are returning so much, and there's so much uncertainty in the market that most investors skipped the bond market and went to cash when the uncertainty hit. And then we got one good CPI number, and they all flew back in and just dumped it right back into equities and skipped the bond market back the other way. So, we're playing tennis right now, and the bond market is the net, and it's just going back and forth over the net. And if that bond market doesn't move, mortgage interest rates don't move. So the only thing that's going to change that is if the federal funds rate does come down significantly, so those high yield savings accounts come down and we hit another uncertainty bump in the market where investors fly out of equities, well, then they might find a home in bonds and that could move it. Or one of the things the Fed can do is purchase, bonds and move money into the bond market themselves. But if that happens, the economy is really hurting and we're going to see a lot less buyers. But those are the things we'd be looking at to see movement in the mortgage interest rate market. And right now, I don't see either of those things happening in the near term.
Nope. And that's why we have these as frequently as do, is things are constantly changing. Like I said, Rich, or you mentioned, we've been doing this over 20 years since the Great Recession. And there's always news to report. There's always moving targets. There's always stuff going on. And if you're watching this is not to paralyze you in terms of any of your decision making. It's to educate you and lean on us for just passing on the information. But again, we won't necessarily tell you what you should do. We'll give you the information so you can make good decisions based on the information that we know.
Yeah. And I think there's been a lot of doom and gloom in the news. We want to finish up on maybe a bright point here, and maybe depending on your perspective, whether you think this is a bright point or not. However, we like to tell you where we're certain, where we're uncertain, where we see things going, but what could change our predictions, because to be honest, these predictions are, good until the next notification from your phone and we see what the president's done next or what the stock market's done next. Or what our global trading partners have done next. We can get curveballs that are from outside the country. So right now, any predictions anyone give you are the least reliable predictions any of us have been able to give in the 20 years I've been in the business. That's probably the best way to put it. And so when we talk about this July perfect storm, we talked about the tariffs coming unpaused on the 9th, the Liberation Day tariffs. We talked about the China tariffs coming unpaused on August 12th. We talked about the next round of GDP data coming in on July 30th. We talked about some fear coming from empty shelves that we'll potentially see here in June. So those are all the things that are trending towards a decline in home prices. And we just showed you that we are, in fact, starting to see that wave build, and we're starting to see those decline in home prices. Here's one thing that could turn the tide, to keep the wave metaphor going and beat a dead horse there. So we have seen a little bit of injunctive relief on the tariff front. So a 3-judge panel in a lawsuit between the Trump administration's private parties ruled that actually what the president has been doing is unconstitutional. He doesn't have the legal right to institute the blanket tariffs the way he has. So we're going to pick this apart because it didn't say he couldn't do any tariffs. So this isn't pure relief. And when we get into anything like this, there's a risk of dissolving into a partisan or a political take. And we don't do politics on this show. We're going to report the news and the numbers. And if this happens, this is what it'll look like in the market. Now, you're all coming at it from a partisan lens. We are too. Most people are these days. And so you might see this as a negative from a political standpoint. We are not giving an opinion one way or another politically. We are saying it could be a positive from a financial standpoint, which is what we care about, what we're reporting to you about. So disclaimer underway. These 3-judge panels said, hey, based on the law that you've pulled in and said gave you the right, Mr. President, to do these tariffs, sorry, you don't. It doesn't give you the right. In fact, the law you referenced limits your tariff power. Only Congress has the power to enact broad sweeping tariffs. Stick a pin in that because we'll get back to why that's important. But it did say this act does give you the right to do some limited specific tariffs, which Trump did in his first administration. He didn't face any court pushback on his original round of China tariffs in the first Trump term, because those were within his scope of limited tariff power as a president unilaterally. Biden continued those tariffs and added a few, again, within that scope of limited tariffs that they have legal right to do. So all presidents have played in this arena, but these broad sweeping, huge tariffs on all countries, on all goods, that he doesn't have the right to do. So the opinion read, hey, you want to tariff steel? You want to tariff lumber? You can individually target some things where you think the U.S. is being targeted unfairly in the trade environment, but you can't do broad sweeping tariffs. Thereby, we're putting an injunction on any future tariffs and requesting that you roll back these broad sweeping tariffs that you've done. Of course, Trump administration immediately appealed And Dave let me know like about 30 seconds before we went on air.
Right.
You want to share that, Dave? What happened?
Well, I just read the headline that there was a temporary injunction on that can continue the tariffs as they go through this court process, this process of appeals. So,
Yeah.
and again, don't know how long that's going to take, but I mean, it was on again, off again in a matter of, like it's
like
just
24
it's a
hours.
roller coaster. Yeah.
Yeah.
So who knows?
So one court said you have to stop and put an injunction on doing the tariffs. And the next court said, well, you've appealed now, so we're going to put an injunction on the injunction. So now the tariffs can continue while they go through this process.
Yes.
And so we're looking at, none of these things move quickly through the courts, particularly with the Trump administration. They're very good at appealing. So 3 months, 6 months, who knows? I wouldn't expect any real definitive anything on this until towards the end of the year. But here's why this is important. If we get a definitive response, and that definitive response is, in fact, Mr. President, you don't have the right to do what you've been doing. You need to roll back the broad sweeping tariffs, and you can't enact any new broad sweeping tariffs. You only have your limited targeted tariff power, and any other tariffs have to go through Congress. As we know, Congress is a very slow moving animal compared to executive order. I like to say that fiscal policy is flying off the Resolute desk quicker than you can say Sharpie these days. And that's not how Congress acts. So we could get some certainty. And what the Fed is looking for in terms of deciding whether to lower, stay, or raise interest rates is certainty in regards to the tariffs. What you out there, our buyers, our informed home buyers, are looking for is certainty. Am I going to have a job? Or is everything that I buy on a daily basis going to triple in price? Is my iPhone going to cost $3,500 when I replace it? Or is it going to stay at the $1,000 it's at now? Without that certainty, you don't want to go out and make big purchases. And we get it. And even if Trump today said, just kidding, I'll stop the tariffs, nobody's going to believe him. There's been too much on again, off again. That uncertainty is there. But if the courts say, no, you can't and you won't continue, assuming that they abide by that, we could get some certainty back in the market. And that could play a significant role in limiting those declines, stabilizing the market, having a softer landing. I mean, if it came sooner rather than later, it could fend off the idea of a recession altogether. So we don't want to paint a definitive picture that the ship is sinking no matter what. It is a very volatile day-by-day situation, and we're going to bring you all the information you need to make a decision. And that particular court case, if it stands through the appeals process, could be some really important light at the end of the tunnel for us financially.
Yeah, I agree.
All right, guys. Well, we've made it 47 minutes. Again, you have listened to two middle-aged realtors prattle on about macroeconomic topics. So you are either a sadist or you are deeply committed to your own financial education. We don't care which. We are just happy you stuck with us. Thanks for watching. We will keep you updated and bring you the best possible information we can so you can make the highest quality real estate decisions possible from the comfort of your couch. Thanks for watching. We'll see you on the next one. I'm Rich Curtis.
I'm Dave Miller. Thank you.
Bye, guys.